Thank you, Vivek, and thank you everyone for joining this afternoon. I see that people are still joining in. I would kickstart with the update on portfolio performance. As you can see on this slide, quarter two was a decent quarter. The portfolio return was 15% compared to BSC 500 of 13.2. So the team generated 184 bips of positive alpha. Uh, while this is over the long term, this is the average quarterly alpha. But coming on the back of a difficult year last year, this certainly felt more than an average alpha for us. Last year, as I was just sharing, was a difficult year, but otherwise, over longer term, the team has generated solid alpha since inception, 116 compared to 90 of the benchmark, including the difficult performance during 22. We, by the way, between our last call and this call, we completed 6 years of the formation of Vito, and we'll be sharing shortly. Since inception, the performance of the team has been very strong. These are all net returns, if I'm correct. Yes, I am correct. Attribution since inception, you'll see now these are in the bottom row. As you can see, the performance is gross of fees and tax, which is what FactSet delivers. And this is the benchmark return. So 47% gross of fees and tax. And the alpha is very well distributed, as you can see from this graph. The blue columns are the stock selection alpha. In each market cap segment, since inception, the teams delivered very robust alpha. In large caps, where it is very, very difficult to generate alpha, 125 compared to 93, and similarly in mid and small also, strong alpha. This is attribution by market. This is attribution by so this is attribution by sector. Again, the same gross of fee and other costs. The alpha 47, 45% comes from stock selection compared to overall 47. So it's very good to see stock selection driving alpha. Stock selection is universally considered to be more driven by skill rather than luck. These are the top contributors over time. So you'll see names coming from a variety of sectors: Coforge from technology, Naveen Fluorine from chemicals, IPCA from pharma, Bajaj Finance and Muthoot from financials, and so on and so forth, including a new age company or a .com, or erstwhile considered as .com, InfoEdge India, which has been very long time holding for myself. In fact, going back to the days when it was considered a high risk .com company. Obviously, on the detraction side also, we have several from across sectors. Good thing to note is the largest detractor is smaller than the 10th largest contributor. The team's risk management and position sizing has worked well, and the law of large numbers has worked well, because over this time you'll see very granular alpha distributed across various names, rather than one or two names driving alpha. If it's just one or two names driving, it can raise the question whether it is a lucky streak rather than good stock selection across the portfolio. These are the top contributors. So Chola, as everyone, probably a lot of people would have noticed, has done very well, over the last 18 months or longer. But also Coforge again appearing in the top contributors. And there are several names which trailed. It was a very strong market, remember. So even names like ICICI Bank, which were up 6.5%, or HDFC Bank up 7%, because the market delivered 13% return. This contributed to positive return, total return, but detracted from an alpha perspective, and hence appear in the bottom quartile. Also, we are showing a peer group comparison. So since inception, here you'll see that the strategy has delivered, the team has delivered 17.5 for the time period that our um, uh, PMS was not up and running. We have used other portfolios, including the AIF. And then if you see the slide here, so these are the different peer groups, yeah, including, so S&P 500, actually the benchmark's been a very solid performer over this 5.5, 6 years at 13%. So the most of managers have underperformed. These 10 other portfolio managers are basically all these schemes where PMS portfolios which are above 2,000 crores in market cap, in size, in AUM. There's a bit of a positive selection bias, and these are all the multi-cap PMSs, not small cap, not mid cap, not large cap alone, but multi-cap PMSs which are more than 2,000 crores in AUM. You'll see most have underperformed during this time because particularly over the last 2 years, and more particularly during 22, the index was a very strong performer and most PMSs underperformed last year, as can be seen on this slide. What this slide shows is performance of these 10 peers and ourselves over each of the years starting from the 2007 inception. So in 2017, as an example, we were the second best strategy. In 2018, which was a very challenging year for most portfolios because mid caps got decimated that year. 2018 and 19 were two back-to-back the worst and second worst year for mid and small caps. And since most PMSs have, like us, a lot more mid and small cap, they were heavily clobbered. Also, 2018 in particular was the worst year for poorly governed companies. That was the year when there were a lot of governance related disasters. So be it names like PC Jewelers, Manpasan Beverages, 8K Miles, Shankara Bilcon, Vakrangi. Most of these names were down 90% or more. The environment was quite contrary to what it was in 2017 and quite contrary to the environment today, where at the risk of generalization, a lot of companies that are companies that are poor in governance, relatively poor in governance, while there's no objective measure of governance, but a lot of companies which did very poorly in 2018 are doing very well this year, and are the companies which did very well in 2017 as well. Yeah, but 2018, we were the best amongst this peer group. In 2019, we were 4th out of 11. This diamond represents what the benchmark was. The benchmark was somewhere in between here. So you can see the benchmark did very well in 2018. 2020, we were again second best. And many of the managers outperformed the benchmark. 2021, we were 5th from the top, and similarly in 2022. And year to date, we are at an average level 5th out of, or 6th out of 11 managers. Benchmark is doing somewhat worse. So we are somewhat above the benchmark. Yeah, but in peer group, actually 22 was better year for us in terms of relative ranking to the peers, because most managers, you can see the benchmark itself was almost at the top, and most of the peer group did very poorly. And since inception, as I was saying, we've done well. Also, we are the only fund which has been, our team is the only team which has been average or above average, or any of the calendar years, because right now the year is only 6 months into the year, and hopefully the team would gain on the rankings. But if you see from 2017 to 2022, we are the only strategy which is above average. Otherwise, all the other managers have been either some year at the top, other years at the bottom. Yeah, some year below average, some year above average, and so on and so forth. White Oak, as you can see, is the only one that has been above average, and over the 5-year period in the best performing strategy. We've also included peer group performance from a 3-year, 5-year, trailing 1 year, 3-year, 5-year, and since inception basis rather than calendar year. Here also, if you see, the performance on a 1-year basis is above average at this time. 3-year basis is also just merely above average, but above average. And on a 5-year and since inception basis, at the top of the comparable peer group. This is just presented in a different format, above and below how peers have performed. So you can see 5-year and since inception is at the top, and here just above average. Now, so obviously last 1 year and 3 years is not been as strong for us as the prior years were. And we've discussed in the prior meetings some of the reasons. We want to just recap in brief, not to be repetitive, but when any combination of the following plays out forcefully in the market, we would tend to have a headwind in our performance. When poor governance segments of the market in aggregate outperform the good governance segments. I know governance is subjective, but I think we've again discussed in the past, a lot of these sectors can be and generally agreed that these tend to have weaker governance than other sectors, and we tend to have a lot less allocation to these sectors. We have a lot less allocation to government-owned companies. And when SMID caps underperform the market, that is also a headwind for us. So what we've done is, in the prior such calls, as you would remember, we've had a number of slides that we go over to explain this phenomenon. We've tried and compressed a lot of that information in this one slide. So it's made it busier. But if I can request everyone to stop multitasking, those who are, and focus for next 3 to 5 minutes on this slide, it would be a good recap of what we've discussed in the prior discussion. So what this slide is, first of all, the timeline is from March 28, as you can see here. That is when there is performance available on Bloomberg over the last, nearly more than 15 years now, of the funds that either I have managed at my prior firm or your White Oak team. Yeah. Now, this blue line, which you can see over here on the screen, this blue line is relative performance of SMID caps versus large caps, starting from an index level of 100. So it means if the line is sloping upwards, like it is here, SMID caps are outperforming large caps. If the line is sloping downwards, like over here, that means SMID caps are performing worse than large cap. As I was pointing out, 2018-19, which is starting from here, pretty much at the start of 18 till pretty much till early till the COVID bottom, SMID caps were underperforming large caps. So when this goes up, it's a tailwind for us. When it goes down, it's a headwind for us. Now, if you look at this brown line now, this brown line is the performance of the market, call it BSE 500, which is say the average, versus the performance of SOEs, which is PSUs, another name for PSUs, state-owned enterprises, utilities, commodities, and so on. Yeah, so there are two-factor risks, if you all remember, in our portfolio. I hope I don't need to go over the whole thing, but I'll just quickly remind these two-factor risks are there in the portfolio because so from a portfolio construction perspective, the aim is to maximize alpha, minimize the volatility of alpha. And alpha comes from stock selection, so our focus is on stock selection. In mid and small cap, there is a lot more alpha potential, so we allocate about 20% or thereabouts more in mid and small cap, and hence when mid caps does poorly, it's a headwind for us. But despite that, in 2018, we were the top performing manager. The reason was this next slide, because we also, for similar reasons as the prior slide, we allocate more capital to what we consider better governed segments of the market rather than poorly governed segments of the market. So in 2018, because poor governance did extremely poorly in the market performance and well-governed sectors did well, this factor being more powerful in our portfolio, overcame the mid-cap factor to generate top-notch alpha. Yeah, so I'll come back to the slides if necessary, but this is a slide we've covered at length last time or previous times, so don't want to spend too much time on that slide. So when this brown line is going up, that means the market is doing better than this poorly governed sectors. And when poorly governed sectors are doing well, then this line would be going down, like in 2022. So basically, when the design is such that when these two lines are both going up, or whenever either one of them is going up, that represents a tailwind. When one is going down, that represents a headwind. On this graph now, you see three colors. What pinkish color, pinkish red, green, and the beige one or the gray one, depending on your color settings. Now, the red zones like 22. So at the top of the graph, you see the time period. So this red zone lasted from December 21 to December 22. The red zones represent those time periods when both these factors are downward sloping, meaning they are both headwinds to us. Okay. The green zones are both tailwinds to us, like, you know, when from 2009 to 2011 or so, or end of 2010 or so. And the gray zone here, which is most of the graph, is no headwind, no tailwind. In a way, think of it as, you know, green is a home ground advantage to us. Red is a ground where particularly difficult for the team to perform, if you were to use cricketing analogy. And gray is more neutral ground. Yeah. Now, in the red zones, there have been 8 red zones in the past, as you can see here, and so on. So there are 8 of these. It was interesting for us to see that each of the 8 times we underperformed by -5, -5, -5, -5, -4, -5, -7, and -11. So each time we've underperformed, this one was the worst, because if you notice, this was the longest lasting. This one lasted for 12 months. All the others have lasted for 3 to 6 months. The green zone, each of the green zones, which is a home ground advantage, if you will, we've outperformed. +16, +6, +9, +5, +6. Now, this is where you are an advantage or where you are at a disadvantage from these dual headwinds or tailwinds. Important to, hence, most important, I would to see how we did when there were neither headwinds nor tailwinds. So you'll see each of these times when there's neither any headwind nor any tailwind, the team has outperformed 5%, 15%, 2%, 36, 6, 5, 15, 18, 8, and now approximately 2%. So when there is no headwind, tailwind, or when there is tailwind, 100% of the time, so far, historically, the strategy has outperformed. When both these are headwinds, the strategy has underperformed each of those times, but then has obviously bounced back, as these are time periods that are not permanent in nature. You don't just play on one ground all the time. The grounds, as the cricket team plays, the grounds keep changing. Some grounds are suitable, some grounds are not suitable for any team. Now, this is the length of time that this phenomenon existed. What this slide shows is the magnitude of these factors at risk. So this is again a slide that you might be familiar. The green and the red over in this graph represent the alpha of the strategy over time. You'll notice that, for most part, it is very solid green, and the worst here is this. Now, what you see in the next row is the performance of benchmark versus the underweight segments of the market, which is the poorly governed segments of the market. And then next is the mid cap versus large caps. Yeah. So here you'll see there have been different times at which these two have been negative. But if you were to simply add these two, it is logically or analytically incorrect to simply add, because one factor can be more powerful than the other. They're not equivalent. Governance is a more powerful factor. But for simplicity, if we were to simply add, this minus 29 has been the most severe time period. Yeah, the prior weak time periods were 2019, 2016, and so on. And you'll notice that sometimes we've been able to, like 2019, overcome this magnitude of headwind. Sometimes we've not been able to overcome. This time it being so severe and stretching out as long as we saw over here, this was like 2 or 3 red events occurring right after one after another without any break in between. And hence the alpha hit of minus 11 compared to what typically was minus 5, minus 6%. Now, I would also highlight again that over this is graph we've gone over before. This has been, so what is represented in this graph is just represented in the next graph that I'm going to share in a different format from a different starting point, maybe somewhere around here, where since the White Oak's journey, if you will. So since our start in August 2017, for the first 3-4 years, that was a tailwind to us, the relative performance of overweight versus underweight sectors. So poorly governed segments of the market were doing poorly. On average, that's why the index went from 100 to 125 over here. Yeah. So upward sloping is a tailwind. And our alpha, you will see, was very strong, super strong during this time. Yeah. And then over the last 3+ years, since the COVID bottom, there has been a pretty much a unidirectional outperformance by poorly governed segments of the market compared to the better governed segments of the market. Now in mid cap, it's a little, so, and over this full time frame from start till year, you'll see that the poorly governed segments of the market have underperformed the better governed segments of the market by 25%. So net, it has been a headwind to us over this 5-year period. Particularly over the last 3 years, you'll notice that it is far more severe. I'm just undoing it. Over the last 3 years, it has been very severe from a 125 odd level to 75 odd level. So a 40% hit from top to bottom, 40% of 125. In mid caps also, you'll see that from starting point to end point, it has been about 20+% headwind to us. Though in the initial 3 years, this was a headwind for us, but at the time, the governance was a good tailwind for us, and governance is a stronger factor in the portfolio. And hence, despite this headwind of mid cap doing poorly, we generated very strong alpha, as I was showing here. And in 21, this mid cap was a tailwind for us, which offset some of this, a lot of this decline or headwind in the governance front. But in 22, even mid cap as well as the poor governance, both were headwinds to us. So there are these factor risks which are very crucial and important to understand while they may not be so obvious at first, based on just the numbers that investors would typically see. Now, oftentimes, investors ask us what is an appropriate time period to measure your performance. Globally, sovereigns and all those do ask. And my typical answer is not a defined time period. Some say 3 years, some say 5 years, some say other figure. I've always said it is appropriate to measure us from like point to like point in the cycle. Okay, with some adequate time period in between of more than a couple of years. So like point to like point in the cycle means what? And like point with respect to what? It is like point with respect to the factor risks that the portfolio is exposed to. Now, we don't do any market timing. So market beta is not a factor risk that we are exposed to. But this is a factor risk that we are exposed to. Now, some people who do market timing or who have a beta of 0.5 or a beta of 1.5, for them, beta would become the appropriate risk factor on which you have to measure like point to like point. Now, if you just measure our performance relative to peer group over the last 3 years, you will find that we've done an average job, as we shared in the prior slide. There's nothing remarkable about our performance. And you would all tend to really like managers who are, because just as we have this strong tilt or bias towards better governed companies, there are many managers out there who have a very strong tilt towards poorly governed companies or somewhat weaker governed companies on the whole in the portfolio. Like take government-owned companies, for example. We hardly own government-owned companies other than for risk mitigation purposes sometimes, yeah. But many managers have a lot, probably the biggest allocation in the portfolio in government-owned companies. And they either have it throughout time structurally because they like the low PE multiple that these guys trade at or the dividend yield that these guys provide at. So if you compare our performance to someone, and there are a lot of those out there that we don't need to name, but there are out there who have such names, not just government-owned companies, but other companies from the sectors that we just segments of the market that we discussed. Then over the last 3 years, they would do fantastically well. Yeah. Now, if I go back to this, if you see over. Okay, let's see 3 years performance. So 3 years. Portfolio 9's done very well. Portfolio 7's done very well. Portfolio 6 has done, portfolio 4, sorry, I missed out. The portfolio 4 has done on a 3-year basis fairly well. So look at portfolio 4, okay? Now this is a good example here. Now on portfolio 4, if we go back to, sorry. So if you look at portfolio 4, in year like 2018 was the worst performing portfolio. In year like 2019 was worst performing portfolio. Yeah. And in 21 was best performing. Now, quite possibly, I don't know off the top of my head, and I anyways won't share with you who is portfolio 4. But portfolio 4 probably tends to own companies where, maybe government owned or otherwise, what the kind of sectors or segments that we talked about. And similarly, portfolio 9 possibly has some, or portfolio 10 possibly has similar traits. So in years like 2018, where we were best, these guys were at the bottom. And in year like 2022, some of these guys are, would be at the high end. Well, some of them are at low end on both the times. But I hope you get what I'm trying to say. If you were to look at this performance in the reverse direction, meaning this is the first year, this is the second year, this is the third year, fourth year, fifth year, sixth year, and so on, then our last 2 years would be fantastic, because these 2 years would show as top performing. But if you understand that these are representing these different time periods in the cycle, and hence this time period is not necessarily an upward, even though it looks like a 3-year time period, it's not a like point to like point on the cycle for our strategy, because this is a major factor exposure in the portfolio. And if you were to look at someone else who has the reverse factor risk, meaning a lot of poorly governed companies, they would have done extremely well over this 3-year period, but their prior 2 years would have been possibly very, very weak. Yeah. And if such a time period comes back again, when poorly governed companies do poorly and better governed companies do better, then that would become a tailwind to us and a headwind to these folks possibly. So how long is a good time period to measure? That is not as simple as anyone would expect, 1 year, 3 year, 5 year, any such number, but it is a function of what factor risks there are in the portfolio and what kind of current market environment is, and when was it last similar market environment. And hence, if you see, it would be okay to measure us from this point to this point. Yeah, if it would be okay to measure us from this point to this point, yeah, or from this point to this point, or to this point. These are all crossing at 100. So on the governance factor, these are like point to like point in the cycle. But in fact, it would not also, I mean, we've had some headwind from year to year as well. Despite the headwind, the performance is top notch. Yeah. But this is somewhat of a non-like to like comparison time period, even though it may be longer time period than from year to year. The reality of investing is it's very complicated. So beyond a point, or let me put it this way, the reality of performance analytics is it is very complicated. And that is why if you just simply go by who's the best performing over the last 12 months, 24 months, 33, 36 months, it does not necessarily play out in forward-looking manner. The best performing managers from 2013 to 2017. So when Modi ji was nominated for by BJP party mid 2013 to December 2017, the best performing managers during those time ended up being most of them ended up being the worst performing during 2018 and 19, and the best performing during 2018 and 19 were possibly lagging the prior years or are facing challenges in 20 year like 22 for the governance factor, which is one of the important dominant factors in most portfolios, yeah, including ours. This just shows our performance compared to international peer group as well, global peer group. Yeah. So just wanted to share that it is not any different over there. We had a blue means we outperformed the peer group, and the darker the shade of blue, higher was our performance. So in 22 in global peer group, sorry, in 20 in global peer group, we were the best performing. In 2019, 21 as well, we were very strong performing. 22, we were below the benchmark, underperformed the average as well, who weren't the worst because there were others who underperformed as well. But relative to the global peer group, we were below average. As you saw, domestic peer group, we were slightly better than average, but global peer group, we were below average. And since inception, though, we are very much at the very top, the second best manager being 14% below us compared to 93, 79.6 in the cumulative sense. And the benchmark is here, but the ETF is here, because remember, benchmark doesn't pay taxes, and these fund performances over here are after paying taxes, because these are funds, not PMS account. We continue to, even this year, we won the Lipper Funds Award globally, as these awards are based on 3-year and longer time periods. In 22, we cleaned out all the awards because they included the prior years, very strong years. Now, what changes have we done in the portfolio over the last couple of years to further mitigate the risk? It's not that we are completely out of the large cap, for example. We do own large cap because otherwise it will be too risky a portfolio. And similarly, the red zone that I showed from a governance perspective, we aren't completely out. Though at the end of 21, we were, from a risk management perspective, somewhat at the outer edge and were more or less completely out. Since then, to mitigate risk, we have added to selectively a few names. So you'll see a couple of changes at a sectoral level. In December 21, information technology services were 8% overweight. Currently, it is more or less flattish, which is also represented here. And in case of industrials, a lot of new additions have been made, and the weight from -1% is now 5.5% overweight. Industrials mitigates the risk. Historically, also, that's been our experience, that when these segments like utilities, commodities, be it metals, energy, and all, and the government-owned companies, when they do well, when the operating performance is strong, they end up doing a lot of capital spending, capital expenditures, which then benefits in turn the industrials. So these industrials do act as a partial hedge, and that is what we've included in the portfolio over the last 12 months or so, which seems to so far have worked well in mitigating that risk. As you can see, the series of names, these are all the industrial names only that we've highlighted here. They have relatively, for most part, outperformed and helped performance over the last 12 months. This is just the performance of some of the participants are invested in our global emerging markets fund as well, and emerging markets ex India. But since there are fewer of those than India strategy, we won't spend too much time detailing these, but the team is off to a very good start in the EM fund. We've completed 12 months on June 23, having started it last year around this time. So the teams delivered in dollar terms 11.6% return compared to EM benchmark of -1 for 12.5% alpha. And in INR terms, 16% return compared to 3 of the MSCI EM benchmark for 13% alpha, just because the dollar has depreciated. There's a little bit extra. This performance of EMX India, as several investors had concerns about whether in their LRS they can invest in EM, which also includes India. So based on that feedback, 6 months after launching our GEM, we also launched the and some of the distribution partners also had expressed that concern that their clients might not be able to invest in a GEM fund through LRS because India is part of GEM. So we are probably the only ones who have a GEM X India portfolio, which we launched towards the end of last year. And since, year to date, if you see, the portfolio has done very well, delivered 10.6% return compared to 4.85 as of end of June for a 576 basis points of alpha. This is in US dollar terms, and this is year to date return in INR terms. Obviously, this year to date, BSE 500 is somewhat lagged emerging markets peer as of end of June. This is just the portfolio composition similar to India. Energy and utilities, we don't have any exposure there, have more in small cap and mid cap combined. Again, I'll skip these slides unless there are questions on EM. This is representative portfolio of EM. So some of the names you'll find very familiar. Hermes and LVMH are the leading fashion giants, including Richemont, which owns the brands like Cartier and Van Cleef. But I'm going to skip these for now. The valuation, obviously, for EM is at on some measures at historical low levels or below long-term averages. Going to keep moving. So this is an interesting chart. Over long term, most markets end up giving similar returns. Yeah, as you can see from 20 to 22, while in the first decade, India did extremely well and global did very poorly. US was the worst performing market in the first decade of this century. The next 10 years, US was the best performing market, and India, in fact, was the worst performing of these major compared to these multi-regional funds during the last decade, 2010 to 20. But when you combine these two time periods, you have, more or less similar range of 3 to 6%. Europe is the laggard, whereas S&P US 5%, EM 5%, India 6%. Now 2020 to 23, India is leading, and that's why obviously everyone is bullish on India, including us all today on the call. My observation is people are most bullish and sentiment is most positive for markets which have recently done the best, as was the case in 2010. Everyone was bullish on EM and India, and whereas at the end of 2020, that wasn't the case necessarily. The FANG and the US and the NASDAQ was most popular at the end of 2020, including, I think all of us can here on the call relate to that sentiment. Over this time, earnings disparity has not been much over the last 3 years, but performance, India has been best performing and EM has been the worst performing. So these all slides we've discussed in the past, so I'm going to keep running forward and see if there is anything else I want to highlight here. I want to highlight one other on the long, So this one, again, to the question of what is long term. Just 3 months ago, there were a lot of client questions and client comments like, over the last 2 years, the market's gone nowhere, or 18 or 20 months or something. I would have made more money in fixed income than I've made in equity markets. And several people also switched to fixed income because fixed income was providing very attractive returns, and there was a tax law changes that allowed before March 31st, if you invest in fixed income, the tax law or some like insurance products or something or the other was more attractive. And unfortunately, there's a lot of switch into from equities to there. Now, over the long term, we've seen this fixed income is a guaranteed real loss, whereas equities are uncertain but compounding gains. And I'm sure many of you have, I've discussed this slide with many of you, but this is from 1985, the year when I got sucked into as a retail investor into equity market. So I can relate to this time period. 1985 to today, fixed deposit of SBI has made 1 crore starting then is equal to 9 crore today. Inflation itself is 14, would be 14 crore. So in real terms, a person has become poorer in fixed deposit. So fixed deposit, everyone believes, is a guaranteed return. You can sleep well at night. Actually, it's not a guaranteed, it's a guaranteed return in only nominal terms. In real terms, it's a guaranteed loss of a small magnitude, not just in India, but everywhere in the world, this phenomenon holds true. Gold has gone from 1 crore to 27 crores, and the Sensex has gone from 1 crore to 176 crores at compounding at 15%. So this right-hand side chart is the same chart as the left-hand side, but this line is if someone is outperformed by 10%. Now, over the last 38 years, it was a lot easier to outperform. It was extremely difficult, but certainly easier than it is today to outperform by 10 percentage points, because markets do become more and more efficient if not every year, every decade. It's an evolutionary way. But there are several who have generated over this time 25% return, and for them, 1 crore would have gone to 4,264% return. 264 crores. So huge difference between 9 crores or 176 to 9 crore to 176 crores to 4,264 crores. Now let's just focus for a minute on the market and fixed income. It would appear from here, this graph, that on every time horizon, the market is ahead of the fixed deposit, because this line is always ahead of this line. But that hides, the reality. Unfortunately, reality is not. The details are, a lot more uncertain or a lot more volatile. So this graph, we have basically broken this this graph, or at least this market line and the fixed deposit line, from rather than showing them in one graph spanning 38 years, we've broken it down into different time periods, starting with the first 1 year starting with December 24, the markets had a strong rally. 1985 still remains the best year on record, giving 100% return. Yeah. And then, someone who's invested in December 84 certainly has always experienced a stronger return than the fixed income return, even after a 50% fall in 93 post Harshad Mehta. Yeah. But at the peak of Harshad Mehta, if someone would have invested or had from year to year, the money went up 16 times from end of 84 to peak of Harshad Mehta scam. Now, most people get sucked into the market right around the top, as we all know, and as evidence suggests. If someone had started at the peak, obviously, of March 92 or something, even until 2009, that person would have been underperforming in the equity market compared to fixed deposit. Still, we all agree equities over time is a superior asset class. Long-term equities provide superior returns compared to fixed income. But there is this big uncertainty factor about starting point and ending point of measurement. So it's not 1 year, 2 year, 5 years. So people 3 months ago were somewhat frustrated that over 2 years, their fixed income was delivering higher return than equity portfolios. But there was a time from a certain investment point in time till 2009 that the fixed income over a 17-year period would have beaten returns from equity markets. And if you see during from March 92 to March 2003, 11-year time period, the difference was huge. Basically, equities were flat from 92 to 2004. Yeah. Whereas fixed income would have more than doubled because in the 90s, the interest rates were very robust. So this first time period is from 84 to 93, the peak of just past the peak of 92. The second time period is from the peak point in 92 to the bottom of the next bull run in March 09. And then this third graph that we've drawn here is the time period where we have a performance track record, which starts from March 7. So somewhere around this time frame is this point. And from here, you'll see that fixed deposit would have given 115% return. Market has gone up 6 times, so 517% return. And the strategy has gone up 16 times because of the strong alpha generation over this time. However, just like the market has not returned in a straight line fashion, and you can see there are different periods like from year to year, over a 3-year time period, the market has underperformed fixed income. Similarly, from this high in 2007, which is equivalent to this high, to somewhere over here in 2013, before the Modi bull run started, from January 2008 to 2013, for a 5-year period or a little longer, because this is just straight line, whereas fixed income would be upward sloping. For more than 5 years, fixed income did better than equities. Yet we all agree, possibly even then equities are the best, certainly compared to fixed income over long periods of time. Similarly, the alpha, if you think of our portfolio performance as equivalent to the equity market and the benchmark performance is equivalent to the fixed income, it is highly unlikely to be the case that we will always outperform over every given time period. And that has not been the case in the past as well. For example, over here, we were here, whereas at some point here, we were lower. So over a 2-year time period, we did underperform, 2 or 3-year time period. Even here if we measure from the peak over here, we regained that point of alpha somewhere over here. So from March 08 to somewhere in 12, point to point, we might not have underperformed. However, if if you combine over the long time period, the alpha generation has been 1,000 percentage points during this time, money becoming 16-fold compared to 6-fold. Yeah. An important caveat I want to point out, these are gross of fees, as is the market benchmark and the FD, because the fees vary from fund to fund, from investor, from share class to share class. So I just caveat that you can deduct 1 to 2% of the fee from this, depending on the share class on an annualized basis. So with this, there are a lot of other things about the macro, but I leave that for most part for Q&A. But now switching quickly to the Indian macro, the earnings growth has accelerated over the last 3 years. While FY21 was supposed to be a disaster year, actually it turned out to be very good. And we've had a 20% CAGR over the last 3 years compared to 5% for the prior 12 years. As the profit cycle has turned from 08 till 20, it was on a decline, bottomed out around 1.5, and now has come back up to long-term average of about 3.5%. As you can see here, FY21, 22, 23, and now projections are for about mid-teens growth. The valuation, if you see, presently at about 20 times, is more or less in line with the Modi era valuation of about 21 times. When viewed from a very long time period, over a 30-year time period, the average is 17. So we are about 10 to 15% higher than the very long period average, but in line with, so call it valuation is within the reasonable zone, be it from price to book or P multiple. From on EM perspective, we are at a 2 sigma or more of a premium because EM multiple has come down due to China's derating. So I've gone up mid cap and small cap. So this is for mid cap. Mid cap premium has gone up over the last a couple of years. So something to bear in mind, and small cap as well, with the big surge over the last 3-4 months. So I'll stop here